Kitco Mining's special coverage of resourcing tomorrow is brought to you by Eris Mining.
Is the junior financing model broken? This is Paul Harris for Kitco Mining at Resourcing Tomorrow in London. And joining me today is Mark Burridge, Managing Partner and Fund Manager at Baker Steel Capital Managers. Mark, welcome to Kitco.
Yeah, thank you very much for having me.
We have an awful lot to talk about, Mark, and I'm really looking forward to our conversation. I want to start with some of the general themes. So let's start with the commodities themselves. Gold seems to be breaking out above $2,000 per ounce. Will it stick, and what will it mean if it does?
Yeah, sure. Well, obviously we follow it closely. One of our main strategies is precious metals mining investment, and we've a lot of positive signs for gold. I think, first thing to note historically, that the last 3 times there's been a pause or a turn in the rate hike cycle, a gold price has rallied by 50% or more. So I think that bodes well for what might happen this time round if that rate hike cycle starts to turn again. I think the other thing which bodes well for gold prices going forward is that we've seen strong demand base being set at that $1,900 to $2,000 level. The jewelry supply chain is happy at those prices. Central banks are obviously very happy at that prices. We saw record central bank buying last year. This year looks set to match that with 800 tons in the first 9 months of this year. And I think those factors combine, and that gold has held so strong in the rate of one of the most aggressive rate hike cycles in history, and a strong US dollar really bodes well for the future of gold to be able to break through 2,000, set new highs. Of course, predicting gold is always a very difficult thing to do, and we don't necessarily need to sort of shoot the lights out gold prices in order to be able to make money in the sector. But I think all the signs are pointing in the right direction, that this might be the beginning of a breakout. But what also clear from the last couple of years is that it's not a straight line breakout. You're gonna be 2 steps forward, 1 step back, and as the gold recovery cycle continues.
Well, yes, it's the 3rd or 4th time gold's been sort of breaking through the $2,000 per ounce level. But whilst it's been at a reasonably historically good level for much of this year, it hasn't really put a lot of air into gold equities. What will it take for the gold equities to benefit from these higher prices?
Yeah, look, I think, just put that in context in terms of some of the numbers, and everybody has different numbers on these, but we'd say that gold equities on a PNAV basis are probably 40% lower than they were just a few years ago when gold first broke out. And there are a number of reasons for that. I think general malaise or volatility in broader equity markets has turned people off equities in general. I think that the gold equities in the last 3 cycles really blew their brains out in paying premiums and destroying value on M&A, chasing marginal ounces in terms of capex. And as a result of that, there's the element of distrust amongst generalist investors. I think for the junior mining companies, there's been competition from things like Bitcoin as alternative speculative investments, just something else to add to that, or cryptocurrencies, I should say, in general. And then the final thing is for the last couple of years, there's been a real fear that inflation would eat mining companies, margins. And it turns out they've managed that reasonably well. So actually, we're quite confident in terms of where valuations sit in the mining companies now, being at a relatively low point, both relatively and historically. So we think it's a matter of companies proving that they can maintain these margins. But probably the most important thing is companies proving that they're going to maintain their discipline. We've seen great discipline over the last 3 years. No blowout M&As, sensible merger of equal type deals, sensible, capital allocation decisions. So companies really need to continue that and continue generating really great profits and record levels of dividends. And I think investors will come back and re-rate the sector if they do that.
It really seems to be the developers, particularly the single asset developers that got hit with the inflation, have really been punished.
Yes, look, I think there's a real question amongst sort of development stage companies or single asset developers. So from our perspective as fund managers, I can point to the fact there's really some really good mid-cap producing companies already with multiple assets. They've got the balance sheets, they've got the cash flow, and they've got the teams to build their own pipeline of assets. So for them to be, to pay a premium to acquire a developer is very difficult when they've got those strengths, especially when investors like us are begging for capital discipline, so they don't make that acquisition. I think single asset developing companies now have to ask themselves how and where do they go for that equity. I mean, there's been a couple of examples recently where companies have issued a series of royalty streaming convertible debt financing in order to fill the debt piece of the companies, and they're falling down on the equity side. And then what's happening is the same companies that were talking to them about a win-win deal 2 years previously are now coming in and able to do deals at probably lower share prices than they would have done if the companies had engaged with them originally. So I think if the mid-cap and large-cap companies are maintaining their discipline, the onus on the development stage companies is going to have to be to seek partnerships with the more established companies, win-win mergers or joint ventures, those types of things, in order to develop those assets. Now, obviously, if gold breaks to really frothy levels and lots of capital gets thrown at the sector, that might break down. But I think we're hopeful that discipline will maintain.
And we've seen that in recent weeks. A couple of deals spring to mind. Calibre taking out or bidding for Marathon Gold. Marathon obviously run into capital issues with the development of its Valentine project. And more recently, the merger of equals between Nighthawk and Moneta Gold, two development stage companies that are,
And those are two of the three examples I can think of this year, in terms of where those things have happened. But there's some good success stories of examples of companies that have got on the front foot to make those deals before they've gone down the road of trying to go it alone. One example is Gold Road in Australia, where in order to develop the Gruyere project, they brought in Goldfields as a joint venture partner. It's just an example of getting on the front foot and doing these deals early. Cisco Mining, similar type of deal. So there's some good examples out there of actually trying to get these deals done earlier on in the project cycle rather than trying to go it alone. Now, time will tell which model works best. Obviously, for some companies, the go it alone model will work out fantastically, but our experience has been that more of the time it's quite a binary risk situation because they always run out of money at the last minute or something like that.
A lot of these deals are increasingly no premium, all stock, all paper deals. As an investor, as a professional investor, are you happy with that kind of structure?
Yes. I think it's the way that the industry needs to go to re-establish confidence amongst the broader investor base. Coming back to the point about a lot of the capital destruction that happened in M&A in the last couple of cycles. And yeah, we'd all love to pick the one company that's going to get taken over by a premium, for a premium price and win that way. But actually, I think the fundamental value creation you get out of those more sensible M&A deals is a real win-win. It's a win-win for both companies doing those deals as those stocks re-rate, as they become stronger, better companies. And it's a win-win for us as investors because instead of rolling the dice a little bit and trying to bet which one's going to get taken over, we can invest in solid companies with sensible approaches to corporate development. And ultimately, if we're right about what will happen to commodity prices, those companies will also re-rate quite significantly and generate good returns. I think the other aspect, just on M&A, what we're at it is obviously if you're looking at the precious metal sector, for example, there'll be a wave of opportunities for mid-cap companies now in acquiring disposal assets from the new Newmont as it comes through next year. And again, that's going to put pressure on the single asset developers because there's now a competing list of good quality assets that just perhaps subscale that others can go for.
How much of a factor or overhang has that been perhaps on M&A at that sort of scale? Because this deal has been on the table for most of the year. So people know it's been coming. And Newmont very early on said they'd be looking to make $2 billion of divestitures or synergies or rationalizations. And so have people that have been wanting to transact been sitting on their hands waiting to see what's going to come out of Newmont perhaps before they make a bid on a single asset junior developer?
I think I don't think it's so much that. I think it's really it comes back to the capital discipline about not wanting to pay a premium to acquire an asset. Because don't forget, not only do you have to acquire it, you've got to generate your double-digit return on the capex. Then if you overlay on top of that the 30 to 50% premium that the junior company might be looking for, there's no way that return profile makes sense in terms of being an investor. So I think it's more about, does the emerging miners need to reinvent their business model in terms of how they access capital? Do you start going to the mid-cap companies as your first port of call and see what deals you can get rather than your last port of call when you've sort of run out of money? And do you hold off doing streaming and royalty deals until you've explored those partnership opportunities? And I can't say there's one approach that's going to fit every company, because it depends on the asset, the geography, the management, all those factors. But I think each specific company probably has to have a long, hard look at what its finance model is going to be, and do they need to get into bed with a company earlier on. So I think that's probably been the main reason why some more M&A hasn't happened in the sector, is companies are still holding out for that acquisition premium, and the acquirers are still wanting to do non-capital destructive deals.
It's been tough times for the junior sector through most of this year, and perhaps arguably for the last 2 or 3 years. There's a paucity of capital available. Raising equity is very, very difficult, if it's possible at all. And when it is available, it's often very expensive in terms of dilution or having to have a full warrant in there. What are some of the things feeding into this? Is there investor fatigue? Is it there's a lack of creativity in the way companies are trying to finance? Is the traditional model for raising finance for the junior sector, is that broken? And if so, what are some of the possible solutions?
There are two elements to it. I think that the first is that right now the whole sector is so undervalued that I don't really need to take the risk of looking for a junior developer when I can buy a mid-cap or even a large-cap company trading at significant PNAV discounts, at least in the way we look at it. And there I'm taking away the binary risk around permits, I'm taking away the binary risk around financing, I'm taking away the geological and engineering risk. So that's the first element, is that I'm seeing value in more developed producers. So there's less pressure on an investor to go lower down the food chain. And I think that the other thing, which comes back to the point I made before, is perhaps the model is broken for junior company finance. It is, the tried and tested model was you raise some debt, you put a royalty or stream on it, the equity markets are falling over themselves to give you the rest of the equity because they think you're going to get taken over, and then someone takes you over for a 30 or 50% premium. I think that model certainly isn't working now. Maybe in a year or two time, if the sector really rallies strongly, it might come back. But for now, I don't think that's happening. I think what's happening is that the potential acquirers are looking for win-win deals where they're not going to destroy capital by making those acquisitions.
So in terms of a number of the juniors that are, a lot of the juniors are running low on funds, they're facing imminent need to recharge their treasuries. It doesn't paint a pretty picture necessarily.
Well, I think the good ones will come through. They might have to be a little bit more creative about how to raise finance in terms of partnering with other juniors themselves. I think there's scope for consolidation amongst the juniors. And this is maybe an interesting side point on here, is the industry all talks about sort of talent shortages in the business. And what you've got is a lot of juniors with a lot of talent. And perhaps if the junior sector consolidated a bit, you might have sort of exploration generation companies that might be able to attract more speculative capital. And what you could end up doing is then of the 10 geologists that are running those 10 companies, 9, and they're all good geologists, by the way, which is why they've been able to find these assets. Maybe 9 of them should go back to being geologists and continue to find the assets. And the geologist who's really good at managing a company should actually become the manager. And that way you still have jobs for everybody, but maybe not everybody's going to be a CEO or a director. But as long as you pay your geologists properly for doing the job they do in discovering new assets, that's just maybe just a side idea that I have is exploration generation companies as something that can consolidate the juniors and provide investable vehicles for companies like us.
I think you make a valid point, Mark, that a lot of geologist CEOs perhaps lack the capital markets experience or knowledge or contacts to be successful in their roles. While we're on the subject of junior CEOs, a lot of them make a point that they've got a sizable ownership stake in the companies they work for or that they're running. They've got a lot of their personal wealth in that company. So they say they're aligned with shareholders. Is there the possibility that they, because of that, they also perhaps make suboptimal decisions because so much of their personal wealth is involved in the companies they're running? So they're perhaps overly reluctant to have dilution for a fundraise or to do a merger of equals deals?
I think there are a number of reasons, for that. I think generally speaking, obviously we like company management to have a meaningful stake in the companies they own or meaningful rewards related to that. So I think on balance, it's probably a good thing. A lot depends on how it's structured. If it's actually structured as real equity in the company as opposed to options, I think that's obviously a lot better. But it does make, coming to your point, it can make management or the founder, perhaps a bit sort of blinkered in terms of the broader set of opportunities that might be there in terms of, examples that you've just talked about in terms of merging with another junior company and, you have one CEO who does the geology and one CEO who does the marketing instead of both trying to do everything, and I think there's some models out there that, that let's see the explorers can look to find out. This is all very good in theory, but, I know from having been a geologist myself, you get quite emotionally attached to your projects and I think that it's, human psychology comes into that and it's a very hard barrier to break. But I certainly, from my perspective as an investor, I'd be really supportive if companies did want to try and get together and create groupings that were perhaps more investable together, as long as they looked after each other and in terms of making sure that the good geologists continue to do good geology or the good engineers continue to do good engineering.
Let's change tack a little bit, Mark. Let's talk about copper. The copper price has been at a relatively healthy $3.50, $3.60, $3.70 through much of this year, although it hasn't really been very, very exciting per se, despite the forecast of a supply gap or supply deficit coming. But recently we've had a couple of supply shocks. The situation in Panama with Cobre Panama, the mine shut there at the moment, and more recently today, last night, the miners at MMG's Las Bambas in Peru, another one of the largest mines in the world, they've gone on strike. What kind of impact will these supply shocks have on the market?
Yeah, well, obviously it's supportive, for copper prices. It also flags to a certain extent heightened levels of political risk in the mining business. So maybe just a couple of small points, but let me look at sort of the underlying trend here is that regardless of the short-term supply-demand balances, we're going to need, by some people's forecast, 60% more copper mined by 2030 in order to meet industrial demand driven by the push towards more renewable energy and reducing carbon and copper's role in transmitting that renewable energy. So I think underlying, regardless of these short-term disruptions, the outlook for copper is quite positive. And coming back to the topic of industry discipline, the copper miners in general have been reasonably well disciplined in terms of building new projects and requiring the right level of returns for those new projects and M&A. So I think it's no surprise that some of the gold companies also want to get into copper and see copper as a significant part of their portfolio going forward. I think the long-term outlook for copper is very, very positive. The short term, yes, I think that is supportive for copper. And you throw on top of that the potential for some Chinese stimulus. I think copper may look more constructive next year than it did 2 months ago. 2 months ago, I think the sentiment was turning against copper, but I think now sentiment is perhaps turning back in favor of copper.
I want to bring ESG into this part of the conversation because both of those situations, that I mentioned in Panama and Peru, you can say there are ESG issues. Somewhere the relation with local communities or workers has broken down. Broadening that out, ESG seems to be a critical factor in the development and green lighting of new copper construction. In addition to that, you've got the increasingly high capital cost of building new copper mines. It seems to be a very, very tough time if you're a copper developer or a big company looking to bring new capacity on stream. And that perhaps explains why there is a sort of paucity of new projects coming through and being built. What's your view on that?
Yeah, well, so we've, like many investors in the sector, we've been, interested in ESG, for decades because, the obvious thing is if you do things wrong on E, S, and G, bad things happen, right? So, but, a few years ago, we took the decision to break out ESG as its own valuation tool. So we developed our in-house valuation tools for stock, financial value, let's say. And now we've developed our own in-house tools for ESG value. And part of that was to get away from using third-party data providers that perhaps didn't understand the sector as well or were just putting labels on things. And what our experience has been on that is that ESG is a key challenge for companies going forward. Absolutely. Coming, especially the social side. So things have changed. On the environmental side, there's much, much less, almost zero tolerance now for any kind of compromise for the greater good. That's sort of out of there now. And I think on the environmental side, there's enough science out there that most of the time companies know how to do the right thing and what the right thing to do is, even if it's a bit more expensive. The social side's a bit more complicated because you can't make everybody happy all of the time when you're building a mine somewhere, particularly when that mine creates haves and have-nots, differentials and gets caught up in national politics in terms of mining nationalization and those types of things. So, but we've actually found that looking at companies on an ESG basis has been very beneficial. First of all, it's another lens from which to look at a company, and through that lens, we get another idea of how companies are managed and how they manage risk, which is really important in terms of investing in these companies in the first place. I think the other thing is when we started, our phase of ESG work 3 years ago, we actually did an analysis based on our first set of ESG work. Do the ESG scores matter in terms of company valuations? And what we did see was that companies with better ESG scores, very roughly speaking, did have higher valuation premiums than companies that had weaker ESG scores.
That's one of the sort of, I suppose, holy grails of the ESG thing is that does good ESG equate to better performance or superior performance?
Yeah, our sense is that it's not proven, but certainly that earlier data that we had a few years ago, we're going to revisit that based on 2023 data now. Now we've, a lot of companies have come a long way in the last 3 years in terms of their reporting and their actions. And it'd be interesting to see regardless of whether or not we can see a clear relationship between the valuation premium and ESG performance. And I'd say actually we can see a rough relationship between that anyway. But regardless of that, actually looking at things through an ESG lens is becoming increasingly important, not just to get a different perspective on how companies are managed, but also to understand how social dynamics are changing. I mean, social dynamics are really changing very rapidly right now in terms of concepts of social equality and wealth distribution, things like that. And companies really need to respond to that. And the community programs they might have put in place 5 or 10 years ago now may be inadequate in terms of community expectations today. Community engagement program approaches as of 10, 15 years ago may no longer be the right type of approach for today. The timelines for that community engagement and stakeholder, building, have extended. So I think that's becoming increasingly important, and that's probably, I think, if I had to point the two biggest challenges for companies coming through the next the next few years. One is going to be the S aspects of ESG, the social side of things, and the other big aspect is going to be maintaining capital discipline, so that a broader group of investors can re-rate their company share prices.
Well, the social side of things seems to be something that's very much not static. It's a continual movable feast, and something that what's good and works for today, as you say, may not work tomorrow, potentially with disastrous consequences. Do you see ESG, and particularly the S aspect, as perhaps being a proxy to identify the better run companies? If they're good at managing the ESG, the social aspects, environmental aspects, they're probably going to be good at managing the financial aspects, the technical aspects, the safety aspects of their operations.
Very much so, yeah. I think definitely it's as I mentioned before, it's a different lens to interrogate how well a company is managed. One thing that we have come across, though, is there's sometimes companies have two different faces of ESG. They have the ESG face that they present to investors and stakeholders, and then they have the reality of what they're doing internally. And sometimes the two don't quite match up. And that's one of the things that we have to do as active managers is make sure that what we're being told actually matches up with what's being done on the ground. Flip side of that is sometimes we come across companies that are doing many great things on the ground, but they don't talk about it. And so we see that happen as well.
Okay, a couple of questions to finish off with, Mark. Given where we are in the sort of current cycle, what would you say is a healthy investment strategy for people at the moment?
Well, you would have to say that because we run two strategies which we think are core for the next decade. We have our precious metals mining equities, and we have our future-facing metals Electrum fund strategy. One's betting on not betting, I should say, investing in the future precious metals, which as we discussed at the beginning is looking bright, and one is looking at the green and renewable energy revolution, net zero, and the metals and minerals that are going to be needed to fund that responsibly. So what we look at and what we think investors should be looking at, let's look at the more established mid-cap to large-cap companies, because they are trading at good value. They've got the balance sheets. Many of them are paying dividends, and they've got incremental growth. And in terms of company profile, we must use ESG as one of our evaluation tools, because that helps not just make sure companies don't get into trouble, but also is a different way of understanding how well a company is run. And you have to be a little bit nimble as well. I think that's part of it as well. So if you're looking at future-facing metals, you have crazy things like you're saying that copper prices held fairly stably over the last year. Well, look at lithium prices. They went from under 20,000 to 60,000 back to 20,000. And so it's crazy because lithium has double-digit demand growth, yet because everybody's rushing into lithium game, you're getting these temporary periods of oversupply. So what you have to do is you have to be nimble and recognize when uranium supply demand is acting in uranium's favor, as it has done recently, and when short-term supply demand issues might be impacting another metal and reacting on the other side. So I think you have to watch the sector and be careful to make changes when you see things happening either with a particular metal or with a particular company.
2023 has been an interesting year. 2024 is just around the corner, Mark. So what are some of the things you expect to see and some of the things you'd like to see next year?
Yeah, I think some of the things that we expect to see and would like to see next year are companies maintaining their capital discipline. So acquisitions being done at sensible values, or actually trying to find win-win merger of equal or JV type deals. We think that along with picking up some of the assets from the Newmont disposals would create a whole new generation of great companies to invest in. I think the other thing which we will see and we want to see is increasing focus on ESG, but real ESG, not greenwashing, so that companies really are tackling these challenges of how we deal with the social issues and environmental best practices. And then I think the final thing that we hope to see, and things are pointing in the right direction next year, we should see a good recovery in not just many underlying metals such as lithium or gold, but also in the equities, which, as I pointed out, are trading at really low valuations. So what I really hope to see is that all the companies doing the right things on capital discipline, doing all the right things on ESG, with a little bit of a tailwind from metal prices, suddenly will get that re-rating they deserve. I mean, to put that re-rating potential in context, in real terms, the gold sector is trading at 50% of its last cyclical highs. And those last highs were set when the sector had weaker balance sheets, weaker margins, were paying less dividends, and had less growth. So you can see that if all those stars align, it could be a really interesting year next year.
I think a lot of people are hoping for exactly the same thing. Mark, it's been fascinating. Thank you very much for joining us today.
Great, much appreciated. Thank you very much, Seth.
And this is Paul Harris of Kitco Mining at Resourcing Tomorrow in London. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of Resourcing Tomorrow is brought to you by Eris Mining.